Welcome to Treasury One's Market Review. Now, last week's US debt ceiling agreement removed some market jitters, allowing EM currencies, including the rand, to rally somewhat against the greenback, albeit marginally. The South African currency continues to hover above the 19 Rand 40 mark against the US dollar. And the rand will likely remain at the mercy of the dollar this week, with plenty of market-moving data scheduled for release out of the US over the coming days. Now, markets will be keeping a close eye on US data to get a better grip on the economy's performance, because while markets have by and large come to anticipate a pause and pivot in interest rates, payroll data released on Friday continues to show a robust US labor market, making a corner of the market wonder whether the Fed has room for one more hike, which in turn could add further pressure on the SARB and the rand. Now, last week's PCE index may support this argument. Last week's release showed a slight uptick in core inflation in April, but then there was the ISA manufacturing PMI also out last week, which contracted for a seventh consecutive month, pointing to continued weakness in local demand. The data seems conflicting, and markets will look to next week's inflation figure to better gauge the Fed's upcoming decision. Over in the EU, the hike cycle seems to be doing the job. The Bloc CPI for May was released last week, with strong disinflationary pressures taking hold. And while this will be good news for their central bank, it's too soon to say whether they will pivot from the hike cycle just yet. China's recovery following its prolonged COVID-19 lockdown continues to be lopsided. Last week's PMI data for May speaks to growing strain in the manufacturing sector and slowing momentum in the non-manufacturing sector. Meanwhile, the private sector services PMI increased for a fifth consecutive month. This as the services activity and government investment in infrastructure are really offsetting the relatively weak manufacturing sector. Now, some policy assistance may be required to bump this rebound along. Then over in Japan, authorities remain dovish as it is yet to reach its 2% inflation target. And although there has been a slight drop in the jobless rate, meaning the demand for labor increased in April, it's not to such an extent that it will sustainably put upwards pressure on wages and inflation. Now, back in South Africa, the data continues to reflect the country's economic woes. ABSA's PMI manufacturing index for May contracted to levels last seen at the height of COVID. And the SARB also released its latest financial stability review, flagging 9 risks to the country's economy. Most of them are known risks, like load shedding, slow growth, mounting state debt, and prolonged high interest rates. But they also added 2 new risks: possible sanctions, that's in light of the recent Russian sanctioned ship saga, and capital outflows. And it's this point specifically which is concerning, because sustained capital outflows could cause disruptions to the South African financial market while further adding pressure on the rand. Now, watch out later this week for our podcast, where ETM Director and Head of Research, George Glenos, and myself will be looking at what is fanning these outflows and the possible extent and impact thereof. Data out this week in SA, the S&P Global PMI out on Monday is expected to remain in contractionary territory, reflecting the headwinds faced by the country. Then on Tuesday, we will see the release of Q1's GDP figure. And while ETM is anticipating a slight expansion of 0.3%, a downside surprise and contraction cannot be ruled out. We'll also be tracking April's manufacturing production data out on Thursday, and while the consensus is an uptick of 2% year-on-year, risks remain skewed to the downside. Internationally, the central banks of both Australia and Canada will announce their latest rate hike this week, and we're expecting no movements from either banks. Over in the US, data on the durable goods orders and wholesale inventories will be released this week, and it is expected to reflect the rate at which the American economy is cooling amid the tight monetary conditions. Then on Thursday, the EU will release its Q1 GDP figure, and we're anticipating a slightly slower rate, but still a 1.3% growth rate for the 3 months through to March. That then the week that was and the one to come for the markets.